Hello and welcome. The Indian capital markets have been hitting all-time highs, but what's happening underneath? Are retail investors coming back in the same way they did in the early 2000s? And what's changing, if at all, in the fundamental character of equity? Well, I'm joined by Tarun Ramadorai, Professor of Financial Economics at Saïd Business School, University of Oxford, UK. Tarun, you've done some work on this subject. So tell us, what are your findings?
So it's interesting. One of the things we've done is we've looked at very large data sets of retail investor behavior in India from roughly 2002 to the present, so over the last decade or so. We find a few very interesting things. I mean, to set the context, I should first say that in terms of retail investor participation, we do find that it's quite correlated with the past performance of the equity market.
Okay.
So when equity markets are moving up, then generally you see lots of entry. And when equity markets are crashing or collapsing, you don't actually see a reversal of participation, but you see a plateauing in the rate at which the new investors come in. So, so the first thing I guess to say about that is that even if the equity markets are volatile, you shouldn't necessarily expect that there will be exit from the equity market.
Okay.
It's just that the level of entry is not quite at the same rate from the retail investor population.
Right.
That having been said, and putting that into context, there are the things that we're really focused on, certainly for the analysis that we've done in the first instance, is learning by equity investors. Now you might ask the question, why is this actually really important? And so the answer is that if you're a retail investor and you don't have a huge amount of knowledge about the Indian equity market, or any equity market for that matter, then how can you improve your performance if you are to participate? And I think we all agree, and certainly finance academia would tell you, that in a market with a positive risk premium, that every investor, every individual should be investing, as long as they are unconstrained, some amount of wealth in the equity market. Now, of course, if you...
That's not happening. Yeah.
Well, yeah, right. But the thing is, if you do enter the equity market and you make all kinds of mistakes, then obviously you're going to destroy any benefits from being in the market. So, for example, if you overtrade, because you just are very convinced that you know something about the evolution of markets, which we all know is very difficult to forecast, then the one thing you're likely to do is to dissipate your money, because your transactions costs are going to be very high and your returns are very uncertain. And so if your costs are going up and your benefits are very uncertain, it's quite clear that you're going to lose money. You can make other...
So you're saying, but that's also the learning, the finding you're saying, that people have overtraded and made mistakes and perhaps have left and not come back.
So what we find is, in fact, quite interesting, that when people come in, they do overtrade, they tend to be highly under-diversified. So this is another way to make a mistake, which is that you don't spread your money out amongst lots of stocks, you invest in just a few. And then of course the third problem is that you have what's called the disposition effect, which is a tendency to hang on to your losing investments hoping that they will recover, and selling your winning investments as soon as they have even the slightest winnings. Now, of course, in a market where there's positive momentum, this is actually something that is going to destroy your wealth. So all of these mistakes do characterize retail investor behavior.
So the flip way of saying is, don't invest in only a couple of stocks, or rather, invest in more than whatever, 3, 4, 5 stocks. Right. 2, don't overtrade.
Correct.
3, try and hold on to winning stocks.
Correct.
And 4, set stop losses effectively.
Absolutely. Yeah. So that's absolutely right. Now, you've just boiled down decades of finance theory into about a minute, and you're right. Succinctly put, that's exactly what you ought to be doing.
But people don't do it, of course.
So retail investors, when they first enter the market, as you say, don't really do this. Now, you might then say, well, do they then get discouraged and leave the market? The answer is they don't. So that's quite good. That's quite reassuring.
And is that more, is that an Indian characteristic, or is it a global?
So it's certainly a characteristic of the Indian data that we've seen, but we also see in other places that, in fact, think about it a different way. An extreme version of the disposition effect is, even if I've been losing money forever in the stock market, I'm just going to hang on and hope that at some point I'm going to recover, rather than exiting. And in fact, then you would expect to see that the guys who won will actually exit, which is a bad thing, because you want those guys to stick around in some sense. Now, this is a problem characterizing people when they first come into the market. But the good news, so I've given you a lot of bad news so far, but I want to give you some good news. The good news is that these tendencies all get much, much better as investors are in the market for longer and longer periods of time. So experience is a harsh teacher, but it's a good teacher. And the experienced retail investors, we find, the most experienced ones, outperform just index investing.
Sure.
Which is terrific. This is great news. Now, having given you some good news, I'm going to give you some more bad news. Okay? So here's the bad news. The bad news is that a lot of this tendency to learn and get better over time is ameliorated by what we would call feeling better. So the name of the paper that we've written is called Getting Better or Feeling Better. So you get better over time, and you feel better, which is actually worse for you, if you make good returns from engaging in bad behaviors. So let's take a classic example. Suppose you go to Las Vegas and it turns out that you gamble all your money on black. Well, in that kind of situation, you've made a lot of money. You've learned that gambling on black is a very good thing. And you keep doing the same kinds of things. Eventually, one day, you lose a lot of money. And so this is one of the problems, which is if you overtrade and for some reason, lucky, you make some money, then you tend to overtrade even more, and this exacerbates your behavior and slows down your rate of learning. So paradoxically, one of the best things that can happen to you is to experience some losses early in your career, because it teaches you how to be a sensible investor going forward.
So at this point in India, we're obviously at all-time highs in the Sensex and the Nifty and so on, and yet anecdotally and otherwise, we are not seeing the kind of retail participation we saw a decade ago or even a decade before that. Right? So what's going to bring them back, and what could or bring them back, and if they do, what should they be doing at this point? So how rather?
Yeah, I mean, I find these statements about retail participation actually decreasing. See, the thing is, I guess what I'm trying to point out is that I don't think retail investor participation is decreasing. It's just not increasing at the rate at which it's increased in the past.
Right. Okay, so
we do have
let's
higher
answer
retail
that question.
Participation. Absolutely. I mean, so I guess then the question is, what needs to be done in order for retail investors to participate some more? Okay. Now, I guess there are a few things that one can do. One is that indexation or the development of index funds or other products like that is obviously something that is very valuable, because it actually forces you to diversify your portfolio, to be very sensible about what you do. If there's ways to encourage the growth of low-cost index funds in the country, I think you'll find that there's going to be a lot more activity. I think that you can default people into certain plans like this, which might be very valuable. In other countries around the world, one of the other things that's helped is the move from defined benefit to defined contribution pension plans. I suspect that in India as well, now of course we're not facing the same issue because our demographic profile is quite different from the demographic profiles in the West. But certainly if we were to see a move like that, that would also spur participation in the equity market. Now I know that the NPS, for example, is an example of that kind of thing.
Right.
So we can certainly see that.
So you're saying bring them in, but through the institutional route rather than any other?
I would have thought that would be important. Now there's of course another aspect to all of this, and this is an aspect that finance research has been going into quite a bit, which is the role of trust. And I think this is an absolutely critical question. If you're the average retail investor, you want to have a level of trust that any savings that you put into the stock market will actually be treated with great fairness. And of course we realize that you can't always make money, you're going to lose money at certain times. But as long as you feel like the process is fair, then it's going to be wonderful. Now, of course we know that SEBI has been moving strongly towards corporate governance standards and tightening those, and that's an extremely positive development. And as soon as you do more things like that to reassure the man on the street or the woman on the street that your savings will be treated with care and protection and trust, and by that I mean a corporate governance code that is well established, I mean enforcement actions that kill insider trading, I mean things like that, then as soon as those facts have been established, you're going to see a wave of movement into the equity markets as well. That's my
So you're saying broadly, I mean, while we can have a set of do's and don'ts for individual investors, I think the system also needs a certain two or three inputs. I think one is you're saying the governance and the perception of good governance.
Exactly.
And the second is, of course, creating the institutional platforms or more institutional platforms, long-term money and so on.
Exactly.
That sounds like a good wrap. Tarun, thank you very much for speaking
with us.
Thanks a lot.
Okay, thank you so much.